evening, in your packet or below your packet, you have a white folded card, and on just about every table there's a black pen. Could you write your first name in big letters? Because my eyes are getting a little older, so I don't see it real well. So big letters there. And now we'll get started. I can look and I can guess that we probably have a whole range of experience in financial management, from people who are just starting out to people who have some sophistication. So it's important that I talk about what the presentation today is going to, the objective of it is, okay? We're going to be talking about financial management, and it is predominantly for people who want to get a beginning grounding on the issues of financial management for a company that they have or that they're starting. That is the primary focus of the conversation today. Now, this is a workshop, but this is a large workshop, so nonetheless, it's a workshop. So if you feel that you want to talk about something in that point in time, just shout out or raise your hand, whatever you're comfortable with, okay? And we'll make sure that we answer your question. Paul and I are from SCORE. Now, many people aren't as familiar with SCORE as we'd like them to be. SCORE is an all-volunteer organization, and it used to be an acronym for the Senior Corps of Retired Executives. Paul and I, we're still working. So it's really not an acronym anymore, it's just SCORE. And what SCORE is a organization that is designed to provide small business with free counseling in business areas. There's 400 chapters of SCORE around the country, and I want to take just about 3 minutes to talk about SCORE, because it's an important resource for you if you are in business or are starting a business. We provide free counseling services. We help people with business planning, with business strategies. And we have these workshops that you see here now. So our mission is to use the business knowledge and skills of our volunteers to successfully guide and lead entrepreneurs and existing small businesses towards their goals. Okay, that's our mission statement. We have 67 counselors in the Akron office. Okay, if you had a small one, it was obviously the second page of a form. That's. I'm sorry for that inconvenience. Anyone else? You have it correct. That's correct. That's correct. Okay. That's correct. It is a government form. Let's get started. How many people here are just starting or plan to start a small business? Would you raise your hand, please? Okay. I hope that you are planning to write a business plan, because a lot of times what happens is we get into a business venture, we just kind of fall into it. Before you know it, we're running 100 miles an hour, and there is no time to write a business plan. But it's the most important thing that you can do. Okay. Now, this is a larger room than we normally present this in, so I can read this right now. I'm guessing you may not be able to. But these are the components of a business plan. And the business plan has a certain structure to it. And let's kind of talk about a business plan together for a moment. Let's start a business. Who has a business idea that they'd like us to start about? It doesn't have to be your idea. It could just be a fanciful idea. Anybody? social networking. Is that so software?
Like another Facebook.
Software product.
Software.
Okay, we want to create a software product, okay? Why do you want to do that?
It's an expanding market. There's a lot of people using social networks, and there's room in the marketplace possibly for another entry.
Okay, so we're together we're all going to help create this social networking software product, okay? And so far, the reason that I have to go home and tell my wife Linda about is that I say, honey, I'm going to do this because there's room in the market for another player. Now she's a nurse. What will her reaction might it be? How much money are you going to make? You know, my wife loves me. She's going to say something like, how much money are you going to make? And will you be happy doing this? Is this something you want to do? Okay. Do we need to do this? Is there a need for this? I mean, so there's room for this. There's room for this, but is there a need for this? Is that because there's room? Does that mean there's a need? There's a need? Not necessarily. Okay. What would be a need for social networking software? An important social need that you could go and say to all these people that you'd like to bring under your company, we're going to do this social networking company, and you would be great in it. We could really make this happen. And let me tell you, the reason why it's important that we have this social networking software is because that's a,
All forms of communication like family have integrated with
there's a real need for family, and that's great, real need for family and friends to stay in touch through some kind of social networking software. There's a need for that, okay? That sounds like a worthwhile need, doesn't it? Worthwhile need, okay? And how will we know if we do a good job? What should we really, you know, we're going to sit around and we're going to say, you know, this is a good idea. We got to have a goal for this thing, okay? How do we know that we're succeeding? Which ought to be what? You get to set them. Go ahead, set them.
Profitability.
What?
Profitability. When can you become profitable? How many years will it take you to become profitable?
Okay. So I'm going to do the social networking software, okay, because it's really important for our society. But I'm going to be happy when I'm profitable. I have 24 people on it. I have no other cost but me, and I live in a tent. So I'm profitable. Am I happy? Yeah, I'm happy. My wife's not, but I'm happy. Okay, so how do you know? Yes, what we're sitting around, we're talking about, we've got this great idea, there's this real need. How do we know what we want to establish as our goal? What is our goal going to be? How do we know what our measurement should be? And a very reasonable argument is when we're profitable. And nowadays, it's a great argument, okay? But I'm saying it's not enough. What? Satisfaction, that's good. Our satisfaction's good, but satisfaction is a tough goal to measure. You know, he implies quite correctly that a goal should be measurable. How about something like, yes? Number of customers. How about our aim is to have 10% of all the possible customers, or all the current marketplace, whatever, 10%. Okay? All right. So now we're starting to know how we're doing. So let's just see what we're talking about. Ownership, he came up with the idea, good idea. I co-opted it and said, let's do it for all of us. So now we all have shares in this, right? So now we're not a sub-S anymore because there's too many of us, right? It's a C Corp, right? C Corporation, not a sub-S corporation. Okay? Market opportunity, well, we talked about that, what that was. And we talked about the mission, that's the higher end reason why we do this, right? And we talked about what the major goals were, 10%. Okay? But along the way, we have to have smaller goals. Profitability is a very good one. Okay? Other goals along the way. But there's some major goal. This is the business plan. It's real important to see that this document provides you with your roadmap to where you're going to go and how you're going to do it. All your department plans are here. Okay? Each of them have to be internally consistent with each other. They all have to be, so you can't have one marketing emphasizing efficiencies and have operations emphasizing quality of delivery. They have to be speaking the same. Putting a business plan together will cause you to focus on the most important thing that you can focus on. There's two things that I'm going to talk about that are very important. One is cash is king, right? And the second one is you've got to know your costs. You have to know the cost of your product. And if you're in business and you're producing more than one product or multiple products, you can very quickly lose sight of what the products are actually costing you to build and sell, or what your service is costing you to actually deliver. Okay, it's very easy to lose sight of that. And if you're not tracking it, okay, well, you're not going to know what your product costs and your pricing. You're not going to know what your product costs are. And if you don't know what your product costs really is, you can't know what your margins are. Okay? And if you don't know what your margins are, you can't know what your marketing strategy ought to be. Okay. So, when you create the business plan, you're also indicating what all of your operating costs will be. You're making a detailed list of that. In addition, you're going to, and we'll come back and spend a lot more time talking about that. You're also going to talk about what your cash flow cycle is. Nowadays, companies are spending a great deal of time understanding their cash flow cycle. It's very important today. And they're doing things on the balance sheet items to make sure that their cash flow is as improved as it can be, such as new kinds of terms for accounts receivable, paring your inventory down. Okay. One of the most important tasks that SCORE does is works with our clients to help them develop their business plan. The part of the business plan that we probably find that people need the most help on is the pro forma section at the very back, because there is an order to everything. There's an executive summary and a mission statement. I'm sure you've done that. Some of you have done this. Note there's major goals. You're going to talk about your different operational areas, departments in the company. You're going to talk about management, and then you're going to talk about you're going to have your spreadsheets of your projections. Now, there's lots of names for these projections. There's pro formas, budget, projections.
Financial plan?
That's it, your financial plan. And so there are a lot of names that people use. It's the same thing. What we're talking about is that for 24 months, month by month, you want to indicate what your sales are going to be, and if you have major product groups, by the different groups, what your sales are going to be, and what your operating expenses, all listed down to what all those operating expenses are, and what they're going to be for each month. And when someone looks at your business plan, when a SCORE counselor looks at your business plan, better the SCORE counselor than your banker, and says, well, it looks like in month 4 you have a sales increase of, why did you get the sales increase? And then can go back, say maybe back 2 months to month 2, and see in marketing, oh, there was a direct mail program. And then goes to the marketing section and says, one of the things we were going to do is direct mail, and when we're going to do it, different dates we're going to do it. So can you see everything ties together and it becomes an explanation. Now that business plan that you do with those projections, that becomes the basis of all of your budget and all your analysis work for all the financial statements we're going to talk about that you're going to use. And so let's get to financial statements. Why we need financial statements. This is a lot of information here. Okay, one was the build a business plan. We just talked about that. The second is you manage your operations to your business, to these projections you create. When you get an income statement, you probably will use QuickBooks or Peachtree Accounting or some software. You may not even use software. You may use a OneWrite system, which is the traditional way before there were computers of doing accounting systems. Okay? But however you do it, at the end of each month, okay, you get a financial statement. You run a statement for the same date. Okay? When you get that statement, it shows you exactly what you did. And it shows you next to it, because you created this, what you said you would do in your budget. Your forecast. That's what you said you would do. And you can look at it, and if you look at it and you say, oh, my sales are up. Okay? That's pretty easy, right? Yeah, sales are over what I thought. But sometimes, and actually more often than not, it's much more confusing as to what actually happened, and you have to look at all of the numbers for your utilities, for all your product costs, to figure out what happened each month. So it's a management tool. You are managing your business by looking at the variances that have taken place. Okay. Another reason is that your business plan is essential if you're going to go and seek financing. I'll just talk very briefly about financing. Credit scores now 720 and up. 20% down and collateral for the rest, and is what the banks are talking about now. I'm always asked at this time, are there any grants available? So I will tell you that all grants come from organizations that are legally required to give from their foundation on a certain frequency, and they have to file that they have a fund available. So there's a person has gone and collected all of this information, put it in a book, and I don't know if we have the book here, but I know down in Akron at the business library there they do. They may have it here. You ask the reference librarian, can you have the book of all of the available grants for the state of Ohio? Okay. You can find it on the internet. Yes, that's almost, nowadays almost goes without saying, but yes. I didn't know that. Find it on the internet. Thank you. Okay? You have to provide a business plan with a financing package. And if you are planning to get financing, I don't know if you are or not, but some of you may be, I want you to keep in mind that, as a reminder, you have to have life insurance for the amount of the loan. And it's people always, they finally get that loan approved, and then they say, where's the life insurance? Now they got to wait for that. So if you're applying for a loan, keep in mind you'll need life insurance. So you need it for the investors, the business plan, and lenders. Especially if it's either one, investors or lenders, you want to have the best business plan you can. Managing cash flow. We talked about that. Okay. There's three financial statements: the balance sheet, the income statement, and the cash flow statement. The balance sheet first. Balance sheet is really a picture on any day, for that day, of what you have on assets that you can convert to cash, really. What you have, liability, what you owe for those assets, and then what your ownership interest is. Okay? So those are the components. It's always balanced, assets and liabilities. And now for another voice, Paul. He's going to talk more in depth about the balance sheet.
Turn yours off. Okay, got it. Because otherwise we cross loop. All right, how does this work? Next. Okay. Welcome. My name is Paul Nesvold, and I'm here to try to explain to you the wonderful world of accounting. To the extent that, I don't know, how many people actually do financial statements today in their business? So quite a few, maybe about a third. You guys are using QuickBooks, things like that? Mostly QuickBooks? What was that? Excel, you do it in Excel? Okay, that's fine, you can do it in Excel. So yeah, those are the tools. Yeah, I recommend QuickBooks just because it'll work for you. If you don't like it, of course, don't use it. But it's readily available. Other software programs are Peachtree. That one gets a little bit more involved. But if you're an Excel wizard, you can do it in Excel. But I think most people would rather let the software do a little bit more of the thinking for them. But at this point in time, I want to make sure you can get in trouble when you're using a software tool, because you still need to understand what's going on behind the transaction. If you just plug stuff in there, that's where you're going to get in trouble. So you do need to understand what are the two sides of every transaction. So in accounting primarily, it's called double entry bookkeeping. QuickBooks will do a lot of it for you, think it through, and present two sides of the they'll present, like, for instance, a bill. They just know if it's a bill, they know the other side's going to be accounts payable. So you're going to tell that screen what the other side is. Okay, so that's what we mean by double entry bookkeeping. The transaction has two sides to it, like a coin. Okay, so looking at the balance sheet, I just wanted to explain the general organization of a balance sheet. As we already discussed, we have assets on the left. That's everything on this side. Liabilities and equities. Assets, starting at the top, the way I try to look at it is these are things, cash is the most valuable asset, not valuable, but the most readily usable asset. It is liquid. It is the most liquid asset that you have. The next one up would be accounts receivable. Anybody want to tell us what accounts receivable are? Anybody want to try to? You in the back. Money people owe you. For what kind of things do they owe you for? Sales. That's right. Accounts receivable, sales. Okay. So these are basically pieces of paper that you've issued to your customers. They have not paid you yet. You've shipped goods because you trust them as a customer. You've maybe done some credit checks on them, looked up their Dun & Bradstreet, feel comfortable with them, or have a past history, and you're willing to extend them credit. So when you extend your customer credit, you give them an accounts receivable. You send them an invoice. So in accounting, you are entering a accounts receivable, and it goes in at that spot. And the other side would be sales. Sales is not on this sheet. It's on a different sheet. That's the P&L. So we are talking about the balance sheet. There are three financial statements, and we'll get to all three of them. Inventory, that's the next thing on your assets list. And inventory is something else that you can convert into cash, but it's not cash immediately. It is, can anybody want to describe what inventory means to them? Anybody? Do you want to give it a shot? You?
material you've purchased to sell?
Sounds good to me.
Products you produced.
You,
ready to be shipped.
right, you could have either bought the stuff from somebody else. If I'm just a reseller, I am buying inventory. Generally, it's on spec. Perhaps you are projecting demand. Cars. You're projecting that you're going to sell a boatload of cars. Who did that recently? Anybody? General Motors. Okay, so they've got a lot of inventory. So you built this stuff either from scratch, like you said. You've bought some materials, raw materials. The raw materials go into inventory. The finished goods are in inventory, so that you could have inventory in various stages of production, but it is goods that you have that you are intending to sell in the future, maybe speculative. Sometimes you need to have the stuff in stock in order to deliver it down the road. The best way to conserve cash, of course, would be if you can do it just in time. That's a terminology that says, if I could get suppliers that can get me this stuff within a day, I don't want to spend a lot of money loading up my balance sheet, investing, getting rid of my hard-earned cash, buying inventory. So think of when you buy inventory, you're converting cash into inventory. So that is a transaction. And we'll go into these transactions. So that's what inventory is. So convertible to cash within 1 year. That's the general convention of everything above this line is a current asset. It's just terminology. Current assets are things that are convertible to cash within 1 year. This next section here is called fixed assets. These are kind of the things that you purchase because you need to have them to be able to operate, but they have a lifetime value that is greater than a year. So you're sitting on some fixed assets right now. You're sitting on chairs. You're working with a table there. This computer here, that's a fixed asset. A lot of the equipment in here, fixed assets. So that's what these are. And these are items that you've purchased. And generally, the key point here is these are items that you bought, but they don't hit your income statement right away. The income statement is meant to reflect revenues and expenses. Well, when you buy a car or furniture, you don't want to generally say that you used it up that day because it's still good. You come back tomorrow and it's still there and you can use it, right? So you depreciate these items. And the point here is that these usually have several years of depreciation. Equipment could be like 5 years. Furniture is usually 7 years, depending on the type. And people always ask, well, how do I know how much I should depreciate that? And I generally tell people, your initial consumer of your financial statements is the federal government. And the federal government will tell you a certain depreciation schedule. So you would just talk to your accountant. He'll probably set that up. You just want to get from your accountant, hey, I've got these assets. What should I do on what's my schedule for it? And you can have an Excel spreadsheet. In fact, that's what I do with my depreciation. Excel spreadsheet. And then you plug them into your financial statements. And then you'd make an entry into QuickBooks every month to say, increase depreciation a little bit for all of my assets. So that's what depreciation is. Depreciation represents a using up of your fixed assets over a period of time. And these are assets that take more than a year to be used up. Okay? Those are your main entries. I don't know, are there any other entries you think we should talk about as assets? Those are the main ones, right? Okay, good. All right, liabilities. These are things that we discussed earlier are things you owe, right? We owe a lot. Accounts payable. Anybody want to venture a guess? You in the back.
It's when money you owe to a company for purchasing bought from them.
All right. Very, very, very good. It is somebody else's accounts receivable. Think of it that way. But it's exactly that. You have purchased goods. They thought you were a good credit risk. They didn't say, hey, I need cash now or I need a credit card now. they have said, I will give you my bill, I will give you my invoice, you will receive it, and you will pay me in 30 days, 60 days, 90 days, whatever. That's what accounts payable is. Accrued taxes, these are things that you can accrue for various purposes. You know, you may have, if you want to do sales tax, generally sales tax, you have to accrue an amount you have to pay the state. And you do not represent the sales tax itself. So if you've ever bought an item, the item has sales tax associated. Even though that's their sales receipt for you, the portion of the sales tax generally is not considered part of their sales. So you just kind of plunk it in here. So you only put on your income statement the sale. Then you plug into this sort of account to say, hey, I've collected that, I owe it to the state. You plunk it in there. And then when it comes to the end of the month, you're going to do your sales tax report. You're going to write them a check, and that goes down. So this account will then be, cleared out once a month. So just a little note on sales tax. Depending on what you do, you may not necessarily need to collect it. That's something you should check with an accountant. But for instance, accountants don't have to collect sales tax. Lawyers don't have to collect sales tax. Some services don't collect it. But if you're selling some goods and services, tangible, it's usually tied to some sort of tangible product or so forth. Best to just check with your accountant on that. And once you establish that sales tax account, you better pay it. They're very, very evil. They will charge you like 300% interest 1 second late. So stay on top of that. Short-term notes payable. Anybody want to venture a guess what a notes payable is? Notes payable? Yeah, that wouldn't be bad. A note is generally like a promissory. I think that comes from the term promissory note, and what they're saying is you've borrowed from somebody, from the bank traditionally, and they may have given you a short-term loan that's either due in 30 days, within a year, anything due. It's the same convention as over here, if it's convertible within a year. So this is the same concept on this side, current liabilities, anything that's due within a year, okay? All right, so we've talked about that. Long debt, these are loans. We're borrowing money. These have longer term, like a mortgage on a property or something. And equity, I think the key point here is there's two types of equity. Now this is sort of what we call net worth, assets minus liability, what's left over, the net worth. The equity is another terminology to say what you have put into the company, owner's investment. That's the key. Whenever I always look at it as an example as a house. When you buy a house, and if that was your business, rental property, you buy a rental property, you have to put some money down. It's your money that you put down. You put down, let's say, 20%. You invest 20% into that property, your own hard-earned money. 80% is the loan. So you've got asset, 100% equals 20% plus 80%, okay? So this is pretty much money that you put in, and sometimes owners take money out. They take it out as an owner's draw, which under certain situations you can do. S-corps do that a lot. So this is an account. Think of it as an account that's specifically talking about money you put in of your own and money you take out. The other concept here is that usually you could be buying shares. You've heard of shares of a company, publicly traded stocks. What they are doing is you are buying a share. If you bought 1% of the company, you'd have shares representing 1% of the company, and you'd be entitled to 1% of whatever this thing produces. Okay, so that's what a share means. You get a share of the action. The last concept in equity, and this is, I think, this is going to take us on to the income statement. This is the retained earnings. Retained earnings. Anybody want to guess? Anybody?
Profits from previous period.
Beautiful. You've done this before. Okay. Profits or? Losses. Okay. So of all previous periods. Of all previous periods. So basically, and that's going to help us understand what is the relationship between the balance sheet and the income statement. The income statement is a whole series of accounts that have a thing called net profit, and that net profit just flows into retained earnings. And I think that's important to help you see the relationship between these two financial statements. Okay. As a side note, I just wanted to point out, because all of these three financial statements are, what are they? Anybody want to repeat what the other two ones are?
Income statement and cash flow statement.
Give that man a beer. Okay, cash flow is tied to this account. So see the cash? If you were to click in, if you got QuickBooks, and you clicked on that account, boom, it opens up, and all of that information in there is applicable to the cash flow statement. Your checking account is kind of like a cash flow statement, although accountants always have to make it more complicated than that, but that's good enough for understanding purposes. Okay, so we've got this thing up here. Clicking on that, you've got your cash flow statement. Down here, you click on that, you got your P&L for all time. Okay, now we're going to talk about accrual basis accounting. Now, this is a concept that says not everything that I do it represents cash. The income statement is not a cash flow statement. And what do I mean by that? I may have sold something on December 31st for, whatever, $100,000. I know I've done everything I needed to do. I've earned that money. I have satisfied every condition that I needed to do to earn that money. I issue a bill. The invoice. So sales goes up by $100,000. Accounts receivable, that's the other side, goes up by $100,000. My income statement, if all I did was $100,000 in that period, saying I got a $100,000 profit. Do I have $100,000 in the bank? Do I have $100,000 in the bank? No. Okay. So that's saying that I've accrued that sale for something that I have not collected yet. A sale you have earned but not have collected. So your income statement, and that's where I think a lot of people get confused, is they're looking at their P&L and they're saying, look at all that money. Wow, look at all that gross profit. But it does, because you haven't always received all your sales and you haven't paid all your bills, that's where it gets a little wacky, okay? So the P&L, what you're trying to do on your P&L when you use a accrual basis accounting is you're trying to say, I'm trying to tell myself the picture of what I owe when I owe it and what I've earned when I've earned it, but it doesn't necessarily mean I've settled up the score with the cash, okay? So that's the key thing. So accrual basis accounting recognizes when you owe or are due money but have not yet paid or received the cash, and that's critical. It shows an expense you have incurred but have not yet paid, okay? What do we call that? What is that on the balance sheet? Accounts what? Accounts payable, okay? Amounts borrowed to be repaid in the future, loans, and then a sale you have earned but have not received, receivables. So think of each one of these has two sides. Accounts receivable, what's the other side? What's the other side to accounts receivable? Sales. Increase sales, increase accounts receivable. Accounts payable, what are the two sides? I got a bill. A bill is usually for some stuff. I guess accounts payable could be multiple things. Could be an expense, something that I am expensing. It has no value. I'm not putting it on my balance sheet. I'm not buying a car. I'm buying paper. I buy paper, I'm going to expense it. Accounts payable here would be accounts payable expense. Increase expense, increase accounts payable. Or let's say I did buy a car or a fixed asset of some sort. Then that account, fixed asset, whatever it is, and accounts payable. So there's always two sides to every transaction. Okay. All right. So we want to start our business. Anybody want to tell me a business that they were going to start? We're just going to use it for fun. Social networking. We're still on that. Okay, so social networking, came up with this great idea. First thing I got to do is, I got to go talk to my lawyer, of course. I've got to create an entity. We'll just. Yeah, we're already in the hole. We might as well just close up now and declare bankruptcy. No. So I've talked to my lawyer, and we've come up with a decision that it should be a C Corp. It's just a form of organization, C Corporation, okay? And, okay, he says, well, let's capitalize this business. Capitalize the business. That's what they're trying to do with all these banks. They're trying to capitalize them. They're trying to put some money in that equity slot, right? So what is a transaction? We're going to put down $10,000. So anybody want to try to guess what that's going to look like? We're going to open up a bank account. That's half your information. What do you do with money when you open up a bank account? Deposit it where?
Cash.
Cash, okay. And then, so we said it's an owner's equity transaction, so what are we getting? Owner's equity. There you go. Okay. There it is. Bada boom. There it is. So basically what we're just saying, everything we're talking about quickly, we're just trying to give you some feels for transactions. This is where you can screw up accounts, QuickBooks really fast if you don't know where to put this money. If you didn't know to choose, QuickBooks is not going to tell you where to put that transaction. You need to know what you're doing. All right, so next one, borrow funds. We go to the bank. You just happen to have such a great idea that everybody in the world will give you money right away. It's 1999. Social networking is hot. It's the internet bubble right before it bursts. You can get money by offering scribbles on a piece of paper. That's how it was. What are we going to do? We're going to borrow $40,000.
Cash is $40,000.
Yep. What else?
And long-term debt would be liability.
You got it. Bank debt. Got it. So we got bank debt. Okay? Assets equals liabilities. Always checking that thing. If this doesn't equal the form, if the formula doesn't work, you did something wrong. Next one. Buy a computer. All right, this is a little bit tricky, but this is trying to reinforce the concept of accounts payable. We first go and we are able to buy a computer from Dell, and they, for whatever reason, they usually don't do this. They usually ask for a credit card, but they'll say, we trust you. We checked out your D&B or whatever, going to give you terms. And so what they do is they give you accounts payable. So what does that mean? You get the asset, increase the asset, $3,000. And then this, I'm trying to do two things on this slide. So step one would be increase payables, right? So just think of that as step one. Then 30 days later, you pay the thing. You pay it with what? Cash. Parentheses means negative, except I guess not in this situation. The negative sign means negative. Okay, so the cash goes down, and then I'm just trying to say that eventually that'll clear out to zero. So at first off, think of it in stages. The first stage is the payable stage. I've purchased the item with payables, and I've received it, I've put it on my balance sheet. This is increasing the size of the balance sheet, and this is offsetting it with the payable. Everything's in sync. Assets equals liabilities. And equity. In this case, that transaction, the equity is not affected. Then 30 days later, we've got to pay those guys because otherwise our credit score is going to go down, and then we won't get good terms. We pay off 3,000, 3,000. Pretty straightforward?
You actually wouldn't have a negative 3,000 in cash until you actually paid the payable.
Right, I'm trying to cheat and getting two things done on this slide. I could have had two slides where it said, you know, computer and payables. Next slide, cash and payables. Okay? So I'm trying to speed it up a little bit. But in QuickBooks, you'd enter a bill. There's that bill screen. You can see it now. They never really tell you in QuickBooks that it's payables, but that's where it's going. And you're going to say, okay, I want to put this in fixed asset account. Boom. I hit enter. Boom. You go look in QuickBooks. You'll go look in your vendor center, and there it is. The bill, it shows open. Then finally, you need to pay the bill. You'll go into QuickBooks, and you'll enter pay bills, and you'll click off this little thing, and it'll write a check, and the check will go out, and it'll reduce your checking account and reduce the accounts payable. That's what's going on. Next. All right, by inventory, it's pretty much the same concept as accounts payable, except this time we're doing it with inventory. Same concept, okay? If you got any questions, please ask. If you guys all got this, just let me know, and we'll move on.
I'll go back one.
Okay?
If I'm Walmart and I'm very efficient at getting merchandise in and out to the stores and sold, and I'm so efficient that I can do it before I have to pay for it, I'm paid for the sale of it. How would you track that? Walmart, in this case, takes responsibility for inventory, right? And on an accrual basis, it owes the $30,000. It sends it out to the stores, and it sells it. And so on its income statement, it gets the sale of that $30,000, whatever that was sold for. And all those sales are paid in either cash or credit cards. So Walmart has the money for that inventory before they have to pay the supplier for that inventory. How's that sound?
Sounds like a
Okay, to me, it's not just an interesting story. There's a point to it, and that is that in today's economy, you want to try to keep your inventory levels very low. If you can, keep the inventory back at your vendor, okay? Get the sales, and then see if you can drop ship to your...
Drop ship, yeah.
Or whatever you can do to keep your inventory dollars
Right.
low. If you have brought excess inventory in, send it back. A lot of times, if you can. Okay, you can do that sometimes. Steel, even raw steel, you can send it back. Okay, and keep your working capital as low as possible.
I think that's a good point. It adds a little bit more color to, these are just raw transactions, but the key thing is inventory will eat you alive if you've got to invest in it. You've got to commit to it. You got to pay for it. So if you're, that's what they always look for is when the economy's slowing down, is when the inventories, they always say, what's the level of the inventories? As they start growing, that's starting to say, well, demand must be shrinking, and they're producing too much, and that's what it's sort of an indicator. So lean inventories for yourselves will be an indicator of how well things are going. If you start seeing inventory just keep bloating, something's not right. Sales aren't real or something. So that's that point. Okay. All right, income statement. Okay, so we've talked about this briefly. We've talked about a sale. We had a sale. And this is where we can talk about, okay, well, how does inventory then get onto the income statement? I first buy the widgets, and they're sitting in inventory. Well, we haven't quite finished the story yet. We want to sell them. That's our goal, right? So when we sell them usually for a profit, for more than what we paid for the inventory, hopefully, right? If we're doing right. So there's some sort of a markup on the inventory. And so you can imagine a sale. Then what we do is when I recognize the sale, I will enter the sale. If it was on accounts receivable will go out. That's number one. At the same time, you try to match the recognition of your expense with the time you earned it. So when I have revenue, I want to try to match the expenses with that. That'll give you an idea of immediate profitability. It's not necessarily cash flow. It doesn't necessarily have anything to do with your cash flow, but this is helping you understand, am I selling this stuff at a profit? I know that when I bought, so much raw material, and I had to put so much labor into assembling it, and I've, I had to add some extra widgets to it. I need to kind of know what the cost of all those things are so that I can recognize the cost of goods sold. That is a key top-line profitability item. Cost of goods sold is trying to represent direct costs associated with the sale of that item. And generally, I think that my colleague over here has got an extensive experience in the manufacturing industry. But the simplest way I think to think about it is these are things that generally vary with the sale of the item. So if I haven't sold it, I don't have the cost. So the inventory stays on the balance sheet until I've actually sold it, right? So it's sort of like every time the bell rings, an angel gets its wings. So every time a sale rings, we have a cost of goods sold, okay? And we've got fixed costs and variable costs. You want to enlighten us on this?
Sure. At the very beginning, I said the most important thing is to know what your product costs are, what your service costs are. Very important. The two components of cost basically are the fixed cost, which is your equipment that you may have, your facility you're using, and your variable costs generally are the direct labor. Okay. There is another component which is called overhead. And that would be factory supervisors, the plant manager, the environmental staff,
These are people directly related to production.
Yes, that's right. It's a good point. Everything related to, all of the costs that we're talking about related to production and only to production, not to the marketing and selling of it, not to the accounting process or the finance administration or human resources or R&D, strictly related to manufacturing. And so that's your variable cost. Now, there are some variable costs, like utilities, that are a very important variable cost. Okay. Now, here's the point I'd like to make about this for the small business person, is that when we create our accounting system, you create the little buckets that capture all your different cost elements. You define what they are. And then when you lay your income statement out, they go out to each of the buckets that are appropriate to it to seek, to get the information. So in cost of goods sold, we'll go out to direct labor and to overhead and to factory depreciation and factory utilities, et cetera. It's really important that you tell your accountant, who often is the one who sets the system up, okay, that you need to know what your product costs are. Because I'll tell you, most of the time, the accountants won't do that. They'll just tell you the gross cost, and you can't tell what's going on with your products. And your costs can be mixed across all your different products. There's no separate product groups, and you're probably going to have multiple product groups over time. And so this reminds me of Babson College. It was one of the first colleges for entrepreneurial people. And they have an overarching theme at Babson College that says all of the obstacles to your growth of your business are put in place when you conceive your business. All of the obstacles, the growth of your business are put in place when you're conceiving it. This is why the business plan is so critical, because you're creating obstacles you don't know. And this accounting system could be one of them, because you don't know, you might end up not knowing which products are killing you and which ones you're making money on. And you think you would know it, but you don't. Okay? So that's why when we talk about the income statement, it brings up the issue of your accounting system has to track your costs very carefully. It has to be, and that has to be a well thought through system.
I don't know if this is working. Yeah? Doesn't sound like it. Can you guys hear me? Okay, fine. I think the thing in QuickBooks, usually they do have a thing called item list. And the way this item list works is as you can order from your vendors, and this is when you have products that have hundreds of pieces parts. That's where it gets really, even 10 pieces parts can get ugly, and inventory is probably one of the hardest things that you can deal with, I think, just because it requires you to keep track of each purchase you make sure you break down that purchase, put it into inventory, and then there's a way to actually, every time you sell a widget, let's say on your sales invoice, you can have an item. This is sort of like the compiled item for all the pieces parts that go into making this saleable item. And when you've got a sale price, and at least QuickBooks does give you an opportunity to say, okay, here's a sales price to it, and it does let you decide what the cost is, and it will actually be smart enough to go out and decrease all the counts. If you wanted to have physical inventory counts, it'll say, okay, I needed 3 of these, 3 bolts, and I needed 2 screws, and I needed 5 plates, and so forth. And this compiled item is sort of like a compilation of all these pieces parts. And at least QuickBooks can at least help you do that. Now, the thing that makes it difficult is you're buying inventory at different prices, and that's where it starts getting really painful. So, a spreadsheet, I can see why you'd want to try to track some of this in a spreadsheet, but you got to be a spreadsheet jockey to make this work. But the idea is you need to kind of know what your average cost is for all these pieces parts that go into making your sale item, so that when you represent your cost of goods sold, it pops out onto the income statement in association with your sales. So that's probably the hardest thing you can probably deal with. So I would recommend just doing service businesses with labor hours. That'd be my suggestion. All right, anything else about that? Okay, operating expenses. These are more things like, they've got them broken down. G&A, that's just an acronym, General and Administrative. Sales and Marketing, S&M. These are the two kind of the main areas. Another one that you might see is research and development as another. There's generally 4 categories. If you look at any financial statement, public financial statement, they generally have, sort of like cost of goods sold is up there. This item right here is gross profit. I guess we didn't talk about that. Gross profit. What does that mean? Gross profit. It's your sales sales minus your cost of goods sold. That's what gross profit is. This is meant to be it's not the end of the world, but it's, people look, they like to talk, oh, what's your gross margin? Oh, yeah, what's your gross margin? Oh, yeah, okay, that's cool. Go ahead. Gross margin and? Yeah, percentage of net sales. You just take the profit divided by your sales. A lot of these things can be, you can do percentages of sales. What's your percentage of sales for G&A? So gross margin is a percent of sales. That's what we're talking about. Gross profit, gross margin. Gross margin is a percentage. Gross profit is a dollar amount. Okay? And this number, the key point about this number is it's sort of like saying, I just know before I've done anything else, the most I can make is that. You can try to cut these things down to a razor thin, but we're just trying to say, just because you got checks coming in doesn't mean you're profitable, gross profitable, that's the point. gross profit has to pay for all of this other stuff. I mean, of course, sales has to pay for all this other stuff. It's an intermediate step. It's just what they do in financial statements.
Can I jump in here?
Yeah, go ahead.
Now, here's one of those interesting little facts. If you cut your profit 10% and your gross profit, okay, here, down here, your gross margin is 40%. I think that's right. No, 30%, sorry. If your gross margin is 30%, and many of you, that's probably reasonable. You have a gross margin of 30%. So if the sales are 100, your gross profit is $30. 30% gross margin. If you cut your gross margin, if you cut your sales price by 10%, you have to sell 50% more to get the same cash. 30% gross margin, cut your price 10% from 100 to 90, you have to sell 50% more to get the same cash.
That's why they say, how do you make money? Volume. Lots of volume.
We see it that pretty much for all the clients that we deal with, without exception, if you're going into business with the idea that you're going to be the low-cost guy, you will not make it. You cannot survive. Now, that's a pretty broad statement, and I could certainly be wrong, but we have yet to see it with thousands of clients at SCORE. The way to succeed is to find a niche that you can exploit. That's the position you want to get in, because in that case, you won't have to be fighting the price game, and if you can increase your price instead by 2%, you'll have a 50% pickup in operating income. Okay? So, a niche strategy.
So basically, he's talking about what is your pricing strategy, and if you a lot of people say, oh, I'll just try to drum up the volume, but it forces you to, it's really difficult to make it up. So, pick a niche, be superior on something that cannot be doubled. Service, time, delivery. If it's a vendor if I can pick a vendor that can get it to me just in time, so that my inventory costs aren't that high, that could be a niche. All right, so these are just other categories, and the good point about Peachtree or QuickBooks, they do offer you charts of accounts. Charts of accounts is just a fancy term to say, here's a list of things. And a chart of accounts is just, it starts with the balance sheet, and every chart of accounts has a cash. That's the first line. So it's pretty much everything we saw on the balance sheet in order, cash all the way down to fixed assets, other assets. Then it goes into liabilities, then it goes down to equity, then it goes into sales, revenue, P&L items. That's your chart of accounts. And so you can have quite a few accounts. You can try to break up your accounts functionally. Let me see if that's the right word. These are departmental. In other words, I have a department for here, I have like our administrative department, I have a sales and marketing department, I might have a research and development department, and then I've got my production / people who fulfill sales. That's what those cost of goods sold department is. Within each of those departments, you're going to have facilities, rent. You're going to have, you could allocate rent, in other words. You may only pay the rent in one bill, but you might want to allocate it by department. You might have telecommunications expenses. You might have a lot of expenses. So in other words, you might have like many repetitive types of items in each of these things. So QuickBooks will generally offer you a P&L that's more activity-based. It'll say rent. It'll say personnel. It'll say postage. It'll say, some other item. So you can just, and that's more, to me, that's more activity-based rather than, it doesn't really put it into departments. Now, when you first start out, departments may not mean so much to you, and there's only one of you or 5 of you, and it doesn't really matter. But as you grow, you'll want to start thinking about breaking it up by departments. So that's just kind of what's going on there. Eventually you get to operating income. This is sort of like the next line after gross profit. You're sort of like your next subtotal, if you will. And then you got your profit and loss before taxes. And what's important is this is the line generally used by your tax return, right? Pay some income taxes. Net income, what does that give you? That gives you the bottom line. So that's the proverbial bottom line. Net income, net profit. Any other terms for the bottom line? No? Let's do it. That's it. We're going to take a 5-minute break. Hallelujah. And there was praise. Hallelujah.
Okay, about ready to get started. It's a first order of business. If you wouldn't mind, would you all pass your white SBA form forward up to the front table up here? Thank you. The simplest business to run, one might think, is this proprietor business, where it's your business. You're carrying, and it reminds me of Uncle Seymour. I don't know why. Uncle Seymour, he was in the air conditioning business in New Jersey, and he had about 8 trucks. So he had 8 crews, and he was working all the time, and wasn't making what he thought he ought to be making with as much work as he was doing. As he spent his whole life growing and getting a second truck and a third truck. And so we made a decision one day that he was just going to let everybody buy their truck out, and that was it. And it was just him and one other fellow running his truck, and he made much more money than he ever made with his 8 trucks. And he was much happier. Okay. Doing bookkeeping for Uncle Seymour would really be a pretty straightforward thing. What happens is that as we start hiring other crews and expanding our business, the bookkeeping system becomes a way of telling us what's going on because we're no longer Uncle Seymour. Okay? So if you're Uncle Seymour, you could get a OneWrite system or a QuickBooks system. Everything we talk about still would relate. From Uncle Seymour's point of view, okay, if he figured he was going to have 3 clients 3 days a week, so 9 clients a week, that would be what he figured. And he figured maybe how much, pick $100 per client, so he'd be having $900 a week, just to put him in the poorhouse, but $900, okay? And when he goes to the end of the week and he looks and he says, well, I had $700 and I had 15 customers. It's easily understood by us that he wasn't making very much money from all his transactions and he was running like crazy, right? Or if another week he might make $2,400 from 6 clients. Well, that was a lot better. And he knows quickly whether his units were short or his sales dollars were short, or average sales were short, okay? He needs to know that. Because if he's running after littler business, okay, he's doing something wrong. He's not networking. He's not marketing himself the right way. So for the sole proprietor, this information is still helpful because it tells you, it tells you if the market you're serving is the right market for you. Now, I told you about Babson College. This is the other college is just Harvard Business School. Their overarching theme is focus. You've got to have the right focus. You have to be in the right business, doing the right things at the right time, the right way. Okay? So you want to have focus. So you're doing, and if you're doing the right, I lost my thought there. If you're doing the right thing, okay. Well, I just really did lose my thought. Okay. Yeah, is that it? There it is right there. Yeah, I wish. Okay. If Uncle Seymour is doing 16 transactions a week when he thought he was only going to do 9, and the dollars for each one is very small, okay, then he has to figure out what he's doing wrong. Now, maybe what he's doing wrong is the way he's marketing himself. He looks like the low-cost guy, and so he's getting all these low-cost people calling him, okay? And he's not making any money. And then comes the opportunity for a nice big one, but he can't take it because he's already working on 3 other little things. So when he finally gets to take the good one, okay, it's taken a longer service time to get there, and so he's not going to necessarily be thought of as the first call to be made by that client the next time, even if he does a good job, because his service wasn't as good as it ought to be. You have to decide who you are and who you're not. And when you decide that, whether you're in business by yourself or you're a big company, you have to, when you decide who it is you are and what you do and who you serve and how you serve it, you cannot go outside of this. Okay? When you do, there are consequences. You go down a road and you become unfocused. So understanding your income statement, where you missed your forecast, whether it was your units were off or your average sale was off or your total sales dollar were off. It's important to know. Another thing with entrepreneurs when they start a business is that they find out that they didn't know what all the costs were going to be. It's an old story. I didn't know all the costs, okay? And that can lead to all kinds of reactions like, well, I got to go to a different supplier, and now that has got its own set of problems, okay? And the other thing on the income statement is what I want to talk about here. Government. There are many, many good ideas for things to do in government. And would we agree that there's not as much money to do all the good things that could be done? I mean, it's just not enough money. And in companies, from the largest company to the smallest, okay, there's no end of good uses of money that could be made. But there's just not that much money available. Today, even less so. And that's why there's the capital budgeting process. Now, this is the opposite of Uncle Seymour. This is where you have a company that's got several divisions. And each division is asked in October to look and say, how much capital are you going to need? We'll define capital as anything you want to spend over $1,000. Okay? How much capital are you going to need for next year? So they're thinking computers and paint by space and all kinds of things. And every department is asked to do that. Human resources, marketing, sales, they all do it. And they provide that information to their department head. They all agree on it. And this usually has a certain format where you indicate what the project is, okay, how much investment is required. And they give you an internal rate of return calculation or something, or a payback, how long before it pays back, okay? And a strategic code. A, B, or C. So this and every department submits that to the division, up to the division executive.
division executive, he knows the marketing and he knows the operations. He knows all these requests because he's heard this and heard this. He knows it, okay? But he has 3 other division execs, all who are doing the same thing. And they all get theirs. And they take them and they bring it up to the corporation. Now, I'm talking big company now, right, to make a point. So the big corporation, they have no idea what human resources in that department wants to spend their money on, whether it's a good idea or not, okay? But the one thing that is certain is that when they add all of the money that's requested, and they only have this much money, they have to make decisions about all of this, right? I mean, this is no different than you. That next year, you forecast you're going to have some money to invest, okay? Now, you may be right, you may be wrong, and you'll have less, or you'll have more, okay? But you have probably a gauge and have a plan for about how much you're going to invest in that. All right, so this is a workshop, so here's my advice on this. When you work with people, and if you're sole proprietor, maybe you're working with your spouse, that's even harder, okay? People are going to come up to you with a really, really good idea. And when you listen to it, the logic is flawless, and the fundamental premise underneath the logic makes complete sense as to something that has to get done. And you'll think about that, and I hope you'll think about what I say now at that moment. You'll say, that's when you say no. Okay, I just want to get it. It's a really great idea. It makes perfect sense, and the answer is no, because you don't have the money. Okay? Now, you may actually have the money, but if you spend it, you won't have the money tomorrow, and you may need that money tomorrow. So, am I saying don't reinvest in your business? Very, 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 very carefully reinvest in your business. Cash is king. You need that cash, and you need it when you don't have it. That's somehow the way that the world works. So you have to say no. And I wanted to take time, since we're talking about operating expenses higher than budget, how does that happen? It happens because people do things that sound really good, like they make a lot of sense, okay? And so if you're a kind of person who says no, good for you. You'll survive. You need to say no. And I say this because I have a brother who's like the girl who just can't say no, okay? Okay, cash is slow coming in. And this makes no difference whether you are a one person or you are IBM. If money's coming in slow, you get more with sugar than you do with vinegar, right? You are nice to people, and and if they can send you 5% a week, that's better than nothing. And it's bite-sized, it's manageable. How can they refuse? Okay? And you're nice to them. Calling and threatening is not helpful. That's understatement. Okay? You also need an aged report. An aged report is every invoice you have and how old it is, okay, and how much money to the customer. So that you can see, and I usually do that by customer. So what I'm looking to see is which calls do I make?